Hello, this is Aaron Wissner from Local Future. It is May the 20th, 2020. I'm here on the line with Ellen Brown. Ellen is the author of The Web of Debt, The Shocking Truth About Our Money, The Shocking Truth About Our Money System, and How We Can Break Free. And this is the fourth edition, which was out in March of 2010. Is this the current edition still, Ellen?
No, fifth edition, 2012. That's it.
Today, we're going to talk about how to get everybody back to work, if that's possible, or how close we can get to it by using state bank money. And so, first of all, Ellen, can you tell us what is state bank money?
Okay. Contrary to popular belief, most of our money is not created by the central government and the Federal Reserve. Most of our money is created by banks when they make loans. That's now been, actually, when I first wrote Web of Debt, that was considered like conspiracy theory, but now it's actually, so many people have exposed that by now that it was confirmed by the Bank of England in 2014 in their quarterly report. And the Bundesbank confirmed it, and the International Monetary Fund, they all agree banks create most of our money. If you look at a chart of the money supply, M2 includes deposits, and deposits are actually created by banks, or most of them. So when you take out a loan, the bank does not actually borrow that money from the depositors, as most people think. They used to, like in the 30s, and what happened was we had a massive depression when the depositors and the borrowers wanted their money at the same time, and they all ran for it, and there wasn't enough money. Now, the bank just writes the deposits into your account, pretends they have the money, and then when you spend that money, say you bought a house, then it would go into the account of the seller. The seller's bank will consider that as a new deposit. So that adds to the money supply. You do have to have reserves, which are transferred from Bank A to Bank B, and that's through the Federal Reserve usually. But what you can do is borrow the deposits that you transfer. So it used to be the banks would borrow from each other, and that was called the Fed funds market, and they borrowed in the Fed funds market, and that's what the Federal Reserve would manipulate. They would manipulate the interest rate in the Fed funds market, and that was supposedly how they controlled the market. But after 2008, banks didn't really trust each other anymore because some banks were risky, and of course the Fed didn't want anybody to know which ones. And so nobody knew who was risky. And so they turned to the repo market. They turned to the repo market for other reasons as well. But the repo market is where large institutional investors go that want a little interest on their extra money that they don't have invested somewhere, like pension funds or, BlackRock, the world's largest asset manager, that sort of thing. And then they lend money overnight, supposedly secured. I could explain all that, but that's tricky. Anyway, they borrow the money somewhere. And we had a big repo crisis in September when interest rates went up to 10% because the big lenders decided they didn't want to lend there anymore because the hedge funds had kind of taken over the market, and nobody trusted the hedge funds.
This was September 2019.
September 2019, yeah. So now, as of March, the Federal Reserve has, so the Federal Reserve stepped in and became the lender of last resort in the repo market. But they wound up, it's a huge market, $1 trillion a day. The Fed was having to make available $1 trillion a day in loans. And everybody liked this because the Fed was such a reliable place to borrow. So they got more people in there borrowing than before, and more shady borrowers. So the Fed found that unsustainable. So in March, they used the excuse of this pandemic to invite all the banks to come to their discount window and borrow essentially for free, 0.25%, but like almost nothing. And all banks, any bank in good standing could do it. JP Morgan's borrowing there, even though they've got the largest pool of deposits of any bank in the country. So it's now effectively free to borrow if you are a bank. But if you are a state, right now they borrow in the bond market. So even in the best of times, like last fall, I think California's bond rates were around 2%. And now there's nobody wants the bonds, they're dumping the bonds along with everything else. And so the bond rates are going up, the interest rates going up. So the Federal Reserve opened this, this is a long way around to answering your question, but the Federal Reserve opened this municipal liquidity facility where states and local governments could borrow, but they have to pay a penalty rate, which could be as much as 3 or 4 percentage points over what the bond rate is. And plus they have to exhaust the bond market first, and then they go to the Fed. And I think Michigan is one where the rate is, so that puts the rate up to something like 7% for Michigan state. And they're in bad shape to start with. So that's clearly going to put them in much worse shape after this crisis, where they don't have the income coming in because businesses has shut down, and they have higher costs because they have to pay unemployment, et cetera. So we have a disaster on our hands. Now, how could the states tap into free money from the Fed? They did get $150 billion under the CARES Act, divided up among the states. So that's about $3 billion each. But they're not allowed to use it on their budgets. Anything that was in the budget before March, they're not allowed to use it on. So it's only supposed to be on pandemic type things. Well, everything's in their budget. They put the police, the teachers, it's all in their budget. The reason they did that is the conservatives don't want them using it to prop up their failing pension funds. So that's all a long story as well. But anyway, the states are in serious trouble. And where can they get the money? But if they set up state-owned banks, so that's what a state bank is. We're talking about a bank owned by a state. And right now, because it's an emergency, the governors could use their emergency powers and set it up very quickly. They could buy a bank somewhere. I saw somebody said there was one for sale here in California for $13 million. In the Oakland area. We have a big public banking movement going now, and the cities are all competing to be first to get their own city-owned banks after we pass this law that AB 857 last fall that the governor signed, that said that states and cities could form their own banks and set out the charter requirements. So you could buy your own bank for $13 million, let's say. And then you can start borrowing at the Federal Reserve for cheap. So what can you do with this cheap money? Because all sorts of businesses are going out of business, and they have to borrow, at best, if they borrow from the SBA, the Small Business Association, they are paying 3.75%. And it's a long and complicated procedure, and it's hard to get those loans, unlike in Michigan, in Germany, where the Sparkassen banks, which is a big public network of banks, or the KfW, which is a big public development bank, is making loans for 1%, very easy procedure, no limit on how much you can borrow as long as you qualify for it. So we could do like they do with public banks. So you've got this free, essentially interest-free credit that you could lend to small businesses and get their business going again. So then they will rush around and hire a lot of people. So that can take care of your unemployment problem. And they should be able to pay those loans back. If now, let's assume that lockdown is over, of course. So people can go to businesses, go to restaurants and all that sort of thing. So now that has some customers and they'll make some money, and the customers will now have money to spend, and so there'll be demand. And so you could even have new businesses starting up if there's people worry that this is going to be inflationary, but it's not inflationary until you run out of capacity to produce. Before that, if there's more demand for shoes, the shoe manufacturer doesn't raise his price. What he does is he puts in an order at the factory for more shoes, and then the factory produces more. So the factory hires more people, maybe new factories start up, et cetera. So that's my very long answer to your very short question.
Well, now can we have a bunch of very short questions with very short answers? And as soon as you get done, I'll know the next question to ask.
Okay, I'm done. I'm done with that. That was my long answer to your short question.
Okay, so first, let me make sure I'm saying this very clearly. When a person goes to get a mortgage or a home equity line of credit, perhaps, they go to the bank and they say, hey, this is the house I'd like to buy. And the mortgage company, the bank says, okay, do you have income to pay us the interest? Sure, I do. I can make the payments, and you have proof of that. And then they say, okay, let's get the deed or whatever. And hey, it looks like the value of that house right now on the market on Zillow, whatever, is $200,000, which might be typical for Michigan. So you have to have 5% down, 10% down, let's say. And so we're willing to go to our computer to create an account, 2 accounts. One account which is it's for $180,000, and we're just going to type this into the computer. I mean, we got to make the line on the spreadsheet or whatever, but we type that in, and that's how much you owe on your principal. But we're going to have, if you don't pay it off in the time limit, we're going to have the house, which is supposedly going to be worth more than $180,000. And then we're going to put that into your checking account, the same exact amount. So now you have credit, we have the debt, plus your promise to pay the interest. And then you take that money and you pay for the house to whoever the buyer is, more or less. But the main idea is you're taking the value of the house itself and you're turning it into debt and credit simultaneously. And this debt is private debt. It has interest required to pay it off. Is that so? I mean, and that's really all there is to it. It's not like the bank has to have cash in the vault to do this. They just have to have a computer that they can say, hey, okay, now you owe, $180,000, and that's where the money actually comes from. And then as you're paying down the principal, that credit is reuniting with the debt. It's bringing the principal down in that account, and the money is being extinguished, or it's vanishing.
Right.
That's the idea, right? Or did I get something wrong?
That's correct. And that's why it's not inflationary that banks create money in this way, because when the debt's paid off, then it disappears. Money is created by the bank and it disappears when it is paid off. It's rather like a big community currency system where you create money by one person does something for another person. And so one person has credits of X and the other person has debits. So now you've got $5 out there, let's say. And then when the person with the credits spends them, it zeroes back out, assuming it was with the first guy. And then you've got no money out there. So money's created and money is destroyed. And in fact, what happens during a recession or depression or a monetary contraction, when the problem is the bank creates the principal, but it doesn't create the interest. So there is always more money owed back than was created in the original loan. And that means debt always grows faster than the money supply. So eventually the debts get so high that people just, and businesses, et cetera, can't take out more debt. And they stop taking out new debt. So they stop creating new money and they pay down their old debts, which extinguishes the old money. And so the money supply shrinks. And then you don't have enough money for people to buy stuff. And so businesses go out of business. It's like in the 30s where you had fruit rotting on the ground and starving people, but there was no money to get for the people to pick the fruit, and there was no money to buy the fruit. And we've got the same thing today where you've got people dumping eggs out and killing pigs because they can't get it to market. And meanwhile, you've got people who are going hungry without the food. So you need the money. Well, of course, right now it's not exactly money. What's missing is the actual transport. Like the Chinese, it turns out, are somewhere in the middle of all that, and they're not supplying it anymore, or whatever. There's some sort of some problem in delivery. And the point is that you need to get some extra money out there. And that's why something like Medicare for all or universal basic income would not actually be inflationary. It would actually level out the prices. In other words, it would keep the market going at its current rate. Another issue is that there are actually two markets. There's the consumer market and the financialized market. That's another issue. In other words, the money is being filtered out all the time from the real economy, and it doesn't come back. That money that all those billionaires have, they are not buying shoes with it. There's only so many shoes a billionaire can wear. They are buying lobbyists and big things, that doesn't have to do with, they're paying big money for big things, and it's not going into the local community, local economy. So if you have your own public bank, you will recycle that money back into your local economy. And so you cut out all the middlemen, so you save a lot of money, and you can pass that benefit on to your local economy and the local people. So you can make below market loans and still be more profitable than a big Wall Street bank. There was an article in the Wall Street Journal in 2014 that said the Bank of North Dakota, which is our one and only state-owned bank, state-owned. We do have one in American Samoa now, but anyway, our one and only state-owned bank is actually more profitable than JP Morgan Chase and Goldman Sachs, even though they're not trying to be profitable. Their mandate is to serve the public, but they've cut out all the middlemen. They have a more efficient business model.
So to kind of summarize that and go back to the point of money creation does not require a printing press. You don't have to actually print cash or coins or currency at all. Money can be created by many different entities, including a state, a municipality, a bank with the cooperation of their the people who are making mortgages with them or making loans with them, a credit union, again, in cooperation with the people making loans with them. It could be made really by a lot of different organizations. And the whole idea is that you have to have either an underlying asset, which is being monetized, or you have some sort of actual valuable good or service that is trading hands, and the money is created to represent that trade happened, and somebody has credit and the other person has the debt or the debit on that.
Yeah, so you could be monetizing your future promise to repay, and that's really how it should be. It seems to me also rather like a community currency system. But in Germany, you have this big Sparkassen network of publicly owned banks. Every little community has its Sparkassen bank, and they're not allowed to lend outside their community. So they're very local banks. And they actually work with so if you came to the Sparkassen bank and you say, I have this great idea, this is my business plan, this is what I want to do, and this is what I want to borrow money for. They'll work with you and they'll look at it and they'll go, well, we don't think this is such a good idea. Maybe you should do that. They'll give you advice because they want you to succeed. They're not just going to sell off the loan to somebody else and let somebody else take the fall. They want to see, they want it to be a good loan all the way through. So they work with local businesses. So you could certainly do it, and they know the local businesses, they know the local people, so they can check, how productive you are, how honest, all that type of thing. Whereas if you're getting your loan from a Wall Street bank, all they know is the credit score they see on their books. They don't know you personally. They don't know what your extenuating circumstances were, that you were in the hospital for 6 months or whatever and couldn't pay, that type of thing.
So for one example, suppose there was a very small credit union, and the credit union said, hey, there's not enough currency in the city so that everybody has enough money. And so what we'd like to do is, if you don't have a mortgage right now, what we'd like you to do is come in and make a mortgage with us at 0% interest for 30 years. And then we'd like you to lend that money, invest it in some businesses. So the monetization would come from that loan, which is made at 0% interest. You wouldn't even have to have it paid back right away, right? It could be a year or two before you even start payments, or it could be like the business could say, I'll start paying you down a year from now, I'll start making payments on it or whatever. But the idea is that anything that currently has a market value that's not being, that hasn't been monetized as debt and credit, could be done with. And also anyone's work in the future that has not yet been monetized. So for example, there's no work that I currently have monetized into the future. I don't have any loans or anything, but obviously I'm healthy. I can work. I could teach or whatever. I'm retired right now, but so as long as there's that capacity, either an asset hasn't fully been monetized or a person's work has not been monetized out too far, there's the ability to create credit that could then be applied just like other money locally or wherever else.
Mm-hmm. And one problem with the current system is that banks like mortgages. I mean, they like houses for security. And so there's always, there are too few houses, basically, particularly say in a big city. And so the price keeps going up, up, up. Whereas they're more skeptical about funding a small business, let's say, unlike in Germany or in China. They fund, of course, a lot of their businesses are government owned, and the government bank funds this business. And they don't worry if a few banks go bankrupt, a few businesses go bankrupt, they don't worry. They just write it off, because it just means you've created some money that's out there and you don't get it back. But you need some extra money in the money supply. In fact, their money supply grew by 1,800% in the last 20 years, and it did not create inflation, because it went into productivity. So their sense is that it's better. And they were the country that pulled the rest of the world through the credit crisis of 2008, 2009, 2010. They just pumped out all sorts of, particularly infrastructure, and hired all sorts of people and pumped out products, and that got the rest of the world going. And how did they do that? They borrowed from their state-owned banks. That the state owns 80% of banking assets in China. So they borrowed from their own big infrastructure banks or whatever. Money created on the books, built, say, high-speed rail. Then the passengers would pay for riding on the train and pay the loan back. And that's what Roosevelt did in the 30s when there was no money. I mean, the banks were bankrupt. And so what he did was he used the Reconstruction Finance Corporation as a bank, although it wasn't really a bank. And it was something he took over from Hoover, the previous president, that had been set up really to help the banks. But Roosevelt just greatly expanded this Reconstruction Finance Corporation. They started with minimal capital, and what they did was sell bonds, and that's how they got their capital. But most of the bonds were sold to the US government, and the US government, of course, just went into debt, as they do. So it was just money created on the books, really. And they used that to anything that was, they were called self-funding loans, anything that would pay back. They made loans to, like, farms and dams and bridges and, electric power plants, et cetera. And that's how they rebuilt the whole country and funded World War II. And at the end of 25 years, they rebuilt the country, won a war, and turned a profit for the government in the process.
This reminds me of the important point that money is really just the oil in the machine. It's the oil in the automobile or the machine. And you should never, it's in a sense, it can be created using a computer at a bank or credit union so easily. It should never be an issue whether there's enough oil to keep the machine going.
Right.
Because that's all money is. It's helping to facilitate trade. That's all it's doing. It's just helping people that have labor. It's helping them to, match their labor up with the need. And it's not as complicated or as one size fits all. It's not just dollar bills that are printed on paper.
Right. And particularly if the money goes for productivity, then that's what it's there for. That's what it's for, to keep the wheels of productivity going. Where you run into problems is when the money goes into the financialized economy. So it just gets, I think 40% of GDP now goes to the financial sector. So they're not doing anything but funding things. So we could cut out that whole 40% if we funded it ourselves, with our own deposits, our own capital, et cetera. And that's the whole idea of a state-owned bank.
Well, my understanding also of a state-owned bank, suppose, and since I live in Michigan, I'm just going to use Michigan as the example. It could be a city, it could be a credit union, it could be a grocery store chain. So if we think of a state-owned bank, though, the state already owns huge assets, right? Because the state owns every state-owned road in the state. It owns every state park, the state waters. There's so much public property. So the money can be created based on the value of that natural resource. Isn't that the case?
Yeah, and that's a problem of how government has always kept their books. If you're a business, you get to count those assets. You paid out money or you owe money over time, but you've got an appreciating asset over here that balances it out. So in other words, you don't say that you're bankrupt because you owe $200,000 on a house. You've got the house, you've got the asset for one side of your books, and you've got the promise to pay it off over time on the other side of the books. But the way government does it, they only look at the debt side and they keep saying, oh, the debt's going up, 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 and they don't count everything that the government owns, which is massive.
Now, so in Michigan's case, Michigan could buy a bank or a credit union. They could start, and they could use that to start creating credit money, debt, zero interest credit money based on the assets of the state, monetizing that. And then they could hire anybody who's currently on the unemployment rolls and able to work. I know a lot of people are stuck at home with kids and whatnot. And they could say, hey, we need you to come in at such and such a time, get a dozen trees and go plant them on your property or in a state park. And we need you to come in and get some brooms, and we need you to clean up the downtown or whatever. Or we need you to, get on the Zoom and just have conversations with people, like elderly people who have not had a conversation with anybody in a week, and check on them. And the state can create all of this, and especially to the extent that it creates something useful, like the trees are growing, right? So that's an asset. And any state could do this, or any municipality could do this.
Right. States are not allowed to create their own money. That's another advantage to having a bank. A bank is allowed to create money, but of course, money that's owed back. But a city, you could create a community currency. It seems to me that a city, even a big city, could issue some sort of warrants. And if everybody accepted them as currency, they could do, like you say. And there are plenty of work of the sort you just named. Like, I live in a senior village, and there are plenty of people here that there's all kinds of things that they would like done for them that they can't do themselves, but they just go without because, you know, they don't have anyone to do it cheaply or whatever. But if that could be a service that the government could pay for, and then the employees would have money to spend, that would get the economy going. They would spend it on goods and services. Most people are in debt, or at least don't have any savings. So if you give them money, they're not necessarily going to go out and spend it anyway. They're not going to go drive up the prices of trinkets. They're going to put it away for, you know, when somebody gets sick, or all those things that people worry about. It just gives them more security.
Another example, in Michigan, there is a very large grocery store chain, privately owned, based in Michigan. I believe the Meyer brothers own this still. The name of the store is Meyer. And it's a very large grocery store chain, but it also has everything else like a Kmart would have. So it's got all the other stuff as well.
Mm-hmm.
And they could easily, legally say, hey, you know, things are tight right now, but we need more employees to do certain work, and we're going to pay all employees minimum wage according to state and federal laws, but we're also going to pay an additional amount. Say the minimum wage is $10. We're going to pay an additional $7 per hour. So it's 17, but that additional 7 is only good for things at our store. Food, whatever you want to buy. But it's good for anything you want to buy here. And it can either be on credit with the store's account, or they could have coupons like Meyer Bucks. And everyone would know the Meyer Bucks are good for Meyer, and they count just like cash. And if you give a Meyer Buck to somebody, then they're like, well, yeah, I know I can redeem this at Meyer. And they could also give it to somebody else and say, you know, can I buy that apple for this Meyer Buck? And yeah, sure, I go to Meyer all the time. So a business like that's selling valuable stuff, that's like a whole basket of stuff, could do this as well, right?
Yes, but the problem then would be that when you spend your Meyer Bucks, the business itself has costs, right? So are they going to be able to cover? I mean, do they make enough profit, or is the difference between what they pay for their goods and services enough to make up for that extra money? You'd have to figure that out carefully. But if it is, sure, that would work.
So they can't just choose any random number. They'd have to like think about it very carefully. It might only be 25% of the wages could be in that, or 10%, or 20%. It would really depend on the business.
Yeah, but a state, I mean, we'd have to change the laws, because states are required to balance their books. But if they weren't, they could, and it seems to me they shouldn't be required to in these circumstances with this shutdown everywhere, because the federal government doesn't have to balance their books. They go $1 trillion. They've been going $1 trillion a year in over budget. So a state could do that too, and just issue the money and put it out there, and it would actually get the wheels of production going, and it would bring in more taxes, and over a long period, it should balance itself out.
So one of the important concepts, I think, here is that when people pay their mortgage or pay their student loan, or pay for their car payment, they are extinguishing money that if they had went and bought something real, a good or service, that money would have been earned by someone and then they would have spent it. But if someone goes and they pay down principal, they are extinguishing that money and it is now gone. It's not oil anymore. It's not available anymore.
Right. Yeah. So you got to get some extra money out there, which right now in good times, everybody's borrowing, or they're buying more stuff, buying more houses or whatever. But in bad times, then they're not borrowing. And that's when the debt gets paid down. And then we have a shrinkage of the money supply, which is called a recession or.
So something that could be done on a nationwide scale is there could be a policy where you only pay the interest and nobody has to pay any more principal down for a while because that's extinguishing money. So let's have a freeze on the paying of principal down. I mean, that would be one way to keep money in people's pockets so they'd be spending it on, and this would not be like a catch-up thing where you have to catch up after 4 months. They could just say for 2020, nobody has to pay their principal down a penny. You just have to pay your interest. That's it. And
yeah, but again, you would have to change the banking laws because the bank would go bankrupt because they are supposed to balance their books. But if it were a public banking system, let's say, and the government just decided that's what we're going to do, or the other option to do like a nationwide debt jubilee would be to move the debts off the books of the banks onto the Federal Reserve's books and just let them be the bad bank, that holds these bad debts that don't get paid back. And then you can keep the bank in business. So it's all a matter of the banking laws, and we could set up banking laws, but you don't want to give banks that power if they're not public utilities. In other words, if they can just use it forever they want, they're never going to worry about small businesses. That's not their problem. All of a sudden, they've got this money machine, money that doesn't have to be paid back. They'll lend it to all their cronies and say, just keep it,
Are there places where banks are public utilities like other countries?
Yes, China for one, and most of their banks, and many Asian countries have a very strong public banking system. Latin American countries used to have a lot of public banks, but we, the United States, have just pretty much suppressed all that. I mean, like Libya had a brilliant public banking system, but that's gone. We killed that one. And in fact, virtually all our enemies in the Middle East had public banking systems till we came in and knocked them off. But it's, it's not we, the people, obviously. It's those big banking interests that control government.
Right. I think it's really important that we make a distinction between individual people and the organizations which represent them, so to speak.
Yeah, I think one problem is that people do not get the real story. They believe the major media, and the major media are owned by these same big financial interests who very carefully filter out anything they don't want us to know. So we think we're the greatest country in the world, and we don't realize what we're actually doing. Just by listening to ordinary TV, you don't realize what's going on in the rest of the world. That's the damage we're doing. But now, because particularly like in this shutdown, people have a lot of time on their hands. And so I think people are watching the internet a lot more than less TV and more internet. And that once you get started, it's quite addictive to find out what's really going on. That's like Web of Debt. It was based on the Wizard of Oz, where you're always trying to peel back the curtain and there's something funny going on here that's not things are not as they seem, and so you want to see what's really happening. I mean, that's what got me into it, and after like 20 years of research now, I'm still not totally clear on everything, but I think I have a pretty good grasp certainly compared to where I was 20 years ago.
Online, Keith mentions the Mondragon Corporation of the Basque region. Are you familiar with that?
Yeah, I went there once with a group. It's good, but the problem is they also are subject to banking regulations. And because Spain and Italy and those countries had serious banking problems, um, their regulators were kind of breathing down their necks. When I was there, I asked the banking people, what about doing this? What about just issuing money or whatever? And they said, well, we can't. We got regulators and we gotta follow the rules. So our best model is still the Bank of North Dakota, which partners with the local banks. They don't compete with the local banks. Yeah.
So we've been talking for about 40 minutes, and now we really get to it. Let's talk about in depth the Bank of North Dakota. Tell me the story. Tell us the story of the Bank of North Dakota, what it does, where it came from, why it's there, why it hasn't been shut down. Let's tell us the story of that bank.
Okay, well, I'll start a little before that, if I may. I'll start with the whole U.S. history of banking. We used to issue our own money. The American colonists issued money directly. That worked brilliantly well until the Bank of England breathed into the ears of the king and said that it is not the purpose of colonies to be independent, that it's their purpose to feed the mother country. Anyway, the king forbade them to issue their own money.
And what did that lead to economically when that happened?
A Great Depression, because they no longer had this source of money. It cut off their local money supply. So
no more oil for the machine.
Sorry?
No more oil for that machine.
Right, the oil was gone. So they fought the Revolutionary War, won the war by printing money. But the problem was that the money was worth nothing at the end of the war. So that's a long story, but
but I want to hear this part though. To what extent do you feel that, or do historians write that it was due to this elimination by decree of the local money that led to the revolution?
Yeah, there are historians that say that was the major factor, that this thing about some tea was just a minor issue, tax on tea, that it was really because they had taken away our power to issue our own money.
So the power to make money is supremely important to any people.
Right, to our own sovereignty. Yeah. So we had a great constitution, but they left out of the constitution who would have the power to print money.
Why was that? I mean, there must have been competing factions.
Yeah, it was, the Continental went to zero and everybody was afraid of the Continental by the end of the war. Well, the reason it went to zero was not because the government was printing too much money, which is what everybody thought. In fact, they were very conservative in how much they printed. It was the Brits who were, they actually had money printing machines on these ships, and they were handing out counterfeit paper. Of course, it was easy to duplicate then. They didn't have all the little threads running through it that we have now in stuff checks. Where
was this before or after the Constitution?
This is before. This is during the Revolution. This is what funded the Revolutionary War.
So counterfeiting money. The British were just counterfeiting money and spending it, and that was screwing up the whole system.
Yeah, so that was inflating the money supply. And there was also the fact that this was an army that may or may not win. So everybody would rather have gold than the paper money of an army that might lose. So the value of the Continental went down, down, down relative to gold, which is typical. Anyway, so anyway, by the end of the war, the money wasn't worth anything, and the founding fathers were just afraid to put it in the Constitution. So
was that a mistake?
It was, yeah. They said Congress shall have the power to coin money and regulate the value thereof. And some, economists read that as meaning that to coin could be read as meaning create money in whatever form. I mean, right now we've got digital money, and that certainly isn't in the Constitution. Who has that power? But you assume that they meant the form of money they had then, and whatever, however it evolved, that would still be the power of money, Congress to do it. But the money supply then shrank again because they really didn't have enough gold to run the system. So Alexander Hamilton, the first Treasury Secretary, set up the first US bank, where he went to the British system where they had a certain amount of gold, and then they issued paper receipts for the gold. So they issued like 10 times as many of this paper currency, which were called US notes. So it was that was our first paper currency after we were a country. And so, but that bank failed, that was shut down. Second bank was shut down.
Why was it shut down?
The second bank was the first, well, both of them wound up getting sold off to British banking interests. They bought it out. We had debts. We had debts to France, for example, and they didn't want our paper money. They wanted gold. And so I guess Alexander Hamilton, he didn't want to actually sell off the stock, but he was forced to do it apparently to keep the books balanced. And then it got corrupted and was used for bad purposes. So then after the second US bank was shut down by Andrew Jackson, we went through a period of depression because the money supply shrank again.
No more oil.
Yeah, no oil. And then Lincoln came along and it was going to have to borrow at 24 to 36% interest from British bankers to fund the Civil War. And rather than do that, one of his advisors said, you don't have to borrow. You're the president. You can just print the money. So he did, and he actually doubled the money supply. And there was some inflation, but there's always some inflation during war times because there are shortages. And of course, again, everybody prefers gold over the paper money of a government that might lose the war. But during and after that period, the greenback period, US notes or greenbacks that he issued, we had a very productive period where the Transcontinental Railroad was built, funded with these greenbacks. It was like the Reconstruction Finance Corporation that it returned a very nice profit to the government, even though the government was just printing the money in the first place. It worked out very well. But Lincoln was shot and the greenbacks that program was discontinued. And
it was discontinued.
Well, it was considered an emergency war measure. And when the war was over, the conservatives said, well, or actually the bankers said, we don't need that anymore.
The private bankers.
Sorry?
The private bankers.
Yeah, they said, you guys can print you guys can issue the coins and we'll print the money. We'll print the paper money, which was supposedly backed by gold. These were promissory notes of the bank for gold they had in the vault, but they would print like 10 times as many notes as they had gold because they knew that people only came for their gold 1/10 of the time. They'd leave, most of the gold would stay in the bank. And that's where the money supply came from, but it was also very risky. On average, there were banking crises in the 19th century every 6 years on average. So we had a bunch of banking crises where people would suspect that the bank didn't have the gold and they would all rush to get the gold at the same time. And the bank would collapse and that would trigger a collapse all over the place. So
and that was the reason for the collapse was because of the transferability, right? Because they were able to demand the gold. I mean, it wouldn't have happened if they couldn't demand the gold. Because if they couldn't demand the gold, what would be the point? I mean, you've got your money, just spend it on your mortgage or your, whatever.
Yeah, but because they were afraid that the bank was going to go bankrupt and other people were going to take the gold and there wouldn't be any gold left, they would all rush to try to be the first to get the gold and then the bank would go bankrupt. And also it used to be that you could take your silver to the mint and turn it into silver coins. And that was withdrawn. Silver was demonetized. So between all those things, the money supply just radically shrunk. And in the 1890s, we had a massive depression, just like in the 1930s. And that generated this huge populist movement, and which is what I wrote Web of Debt about. Wizard of Oz was actually a monetary allegory based on the first ever march on Washington in 1894 by a bunch of farmers and out of work factory workers that went all the way from Ohio to Washington, D.C., seeking a return to Lincoln's greenback system, which failed. And then so the populist movement.
So is this real? Is this the
Yeah,
Wizard of Oz?
really.
Is this real? I mean, did the author like tell people that this is why he wrote the book, or that's what inspired him when he wrote the book?
No, but there's so many things that indicate that that's true. I mean, it was just think about the plot. What kind of children's story is this, where you've got these beings marching off to a Emerald City seeking relief for all different kinds of things? He was it is known for a fact that he marched for William Jennings Bryan, the populist candidate, by night, but by day he had a newspaper, and it was a conservative newspaper. He had bought it, I guess, when he got there in this city in Kansas or Nebraska, and so he couldn't say those things in his newspaper in the editorials, but he could say it in a children's story. So he just wrote this whimsical story about what was really happening here. So anyway, we had this very large populist movement, which failed, but it generated a whole lot of interest. And the Bank of North Dakota was an extension of that movement. So that was the only thing that really succeeded. Was the North Dakotans in 1919 managed to win the nonpartisan league managed to win an election and they got their governor in, and they set up the state-owned Bank of North Dakota and a state-owned granary. They were losing their products their farm products went to the granary, which was owned by a cartel that also owned the railroad, that also owned, it was a Rockefeller cartel that owned all three of those things. And they didn't really have any recourse. And the prices were so high that they were losing their farms to out-of-state banks. And they wanted to keep their money in the state. And that's why they set up this Bank of North Dakota. And
the loss of farms, that reminds me a lot of the loss of farms that have happened over the last 30 years.
Yeah, very similar. I think there's always been a movement to get the land, really, to get the farmers land and force them into the cities. I mean, that's true everywhere, China, etc. Get the land, get the people off the land into the cities where they could work at the factories you could make them work at the factories. They don't have any way of supporting themselves other than go to work for the man, whatever, 10 hours a day, that sort of thing, or the woman these days, I know. So the Bank of North Dakota was set up. It worked they struggled in the beginning. Of course, they had political issues, but it got more and more successful. And in the last 15 years, it's had record profits year after year after year. I think they've averaged 17% over the last 15 years. And this is true even though they're an oil state, and oil just collapsed after 2014. And it's like utterly collapsed. And still, the bank is turning out record profits. And why is that? So it used to be thought, well, it's all because they've got oil, they're an oil state. But obviously not true, because nowadays the oil is not helping them, it's hurting them. So I started writing about it after 2008, because in fact, that's when I did a PowerPoint there at your conference.
Yep.
Yeah, this first PowerPoint I ever did. It's quite about that.
And that's online. If someone wants to search up Ellen Brown, I'm sure that's online on the Local Future channel somewhere.
I think it's somewhere on my channel as well. Yeah, so that was great that you asked me to do it. So the reason I talked about the Bank of North Dakota was that I was following it because I knew it was the only state that had its own bank. So I was just curious to see if that did anything. And sure enough, first there were four states that still were in the black, didn't go have budget crises. Then there were three, then there were two, and then there was one. North Dakota was the only one that totally escaped the credit crisis. They had the lowest unemployment rate in the country, the lowest default rate, the lowest foreclosure rate. They had 6 times as many banks per capita, local community banks, as any other state. So the business model is that the state, by law, all of the state's revenues go into the Bank of North Dakota. So that's its capital base. And then they can leverage all that money into credit for the local community. So they cut out all the middlemen. They don't have no private shareholders, obviously, getting dividends, no $20 million a year CEOs. And they actually have quite low cost because they don't have a lot of branches. They've now got a second branch, but they only have 2 branches, and you really have to live in the capital city to really even bank there. They're 98% of their deposits are from the government. They're not individuals. And they partner with the local banks. So the local banks, if they have some loan that's too big for their capital base or whatever, they're not allowed to take on that big of a loan, say for a development in the local town or something. They would have to give that loan away to a big Wall Street bank, and they would lose a customer. But what they can do now is they partner with the Bank of North Dakota, which might take 90% of the loan. So they come in with the financing, basically. But the original bank gets to keep the customer. They service the loan. Maybe they have 10% of it for that they get profits off of. So it's a great partnership that the Bankers Association in North Dakota endorses the Bank of North Dakota. They all work together very well. In fact, it says in their charter that they're not allowed to compete with the local banks. They can compete with the Wall Street banks, of course. So that's the key. To them, it's a very conservative state. It's a Republican state. But to them, it's not about the government owning a bank. It's about, we want to keep our money in North Dakota to leverage for our own purposes. We don't want to give that part away to Wall Street to be investing in things that we don't approve of and that we're not getting the benefit of, and they're taking advantage of us on our mortgages, et cetera.
And so the Bank of North Dakota provides loans, and to whom? I mean, does it fund the state employees? Does it fund the pensioners of the state? Does it fund roads and public works? Does it fund farms? I mean, what things can a person do how does the money get out of the bank? Like, where's the spending happen?
Well, they can they can take government agencies, for example, for customers. So they make loans to different agencies in the government, and they make loans in partnership with local banks. And if there's an area where they don't have any local banks, like a rural area, and somebody wants a mortgage and there's no bank out there, then the Bank of North Dakota can go out there. And they were the first bank to do student loans. So that was really a third of their business up till recently. But now, because the government has taken over student loans, they still have student loans, but it's not nearly that major portion of their business that it used to be. But mostly they're just working with the local business. So they're keeping the local business, the local bank in business. Whereas in California, we hardly have any local banks anymore because they've all had to sell out to the big banks because of these regulatory requirements after 2008. I mean, the local banking business has been shrinking for 20 years. I think it started with the Patriot Act, where they put in these onerous regulations where you have to know your customer, which means a whole lot of bookkeeping that you have to do, that it's just extra employees you have to get. So a big Wall Street bank they've got the resources to do all that. And the local banks would just wind up selling out to the big banks rather than trying to struggle with all that. And then after 2008, of course, it got even worse. And so the whole local banking business has shrunk. I don't remember the percentage, but at least 2/3, I think, in the last 20 years. But in North Dakota, they still have 6 times as many community banks as any other state. And it was the community banks, for example, with the this payment protection plan. That's the word. Payroll protection plan. They have done more of those payouts than any other state, and that's why, because they're working through their community banks. They have this huge network of community banks, and it's that whole system was kind of managed by the Bank of North Dakota, and it acts as a banker's bank for the community banks. So it's got a line of credit with the Federal Reserve, and then they can borrow very cheaply from the Federal Reserve, and then that allows them to step in and share in these loans that the commercial banks are doing.
So the state of North Dakota could, if they wanted to, they could have like a public works program where they said, hey, if you're out of work and you're off the unemployment, come on into the school or the Secretary of State or whatever whatever state agency there is in your town or community, and we will give you something to do, and then we'll pay you for that thing that you did. So we're going to give you a broom and you go clean. We're going to give you show you where the trees are to plant. And they could do that. They could create all sorts of public jobs if they wanted to, because they have this ability through the bank and through the community banks to create as much money as necessary to keep everybody.
Yeah, the limitation of a bank is it is created as a loan, but if it's a public bank, and if you can borrow for 0%, 0.25% from the Fed, then you could make extremely cheap loans. So you could lend to a state agency effectively for free, and the state agency could set that system up. And because you know that you're putting people to work that are then going to spend the money, which will stimulate your economy, and they might even, I mean, they're probably below tax. They're probably not taxable because they're probably below the, you know what I mean? They're not going to make a lot of money by street sweeping or whatever, but they will be spending money into the economy. And in a time like this, that's what you need. You need money spent into the economy. I just saw there was a recent press release by Jay Powell, the chairman of the Federal Reserve, and that's what he was saying. We got to spend. We got to spend more money, get more money out there. And that would definitely be one way to do it. I mean, you might not want to do that when in the good times when you've already got a lot of money flowing, because that might conceivably, you might hit your limit in productivity. That's a possibility. But in times like now, if that's what we need, is things like that.
Well, it seems like there's certain things that could easily displace imports for a place like imports into the state, like for North Dakota or for any state. For example, if you went down to the state building and you said, hey, I needed some work to do, and they said, great, we have a community garden just over here and we need this planted because then we're gonna have this food in the late summer and spring for people to buy. And so that's actually productive, right? So gardening where you're actually producing something, you're producing food. I mean, and that's the number one thing, right? And then people can buy it and the money goes back to the state. So it's being issued by paying the farmers, the gardeners, whatever, the community gardeners, and then it's coming back in when people buy the food. And then that displaces the importation of that same food, whether it's potatoes or tomatoes or whatever it happens to be.
Yeah, no, that's the ideal. If you can, I mean, that's what Roosevelt did. If you can hire people to actually produce things, you definitely have a balanced economy there, because you're going to sell those products and you can pay back the loan with the products that you sell. I mean, even a state agency could do that, balance out the books with the proceeds from the food they just produced. But even, it seems to be even things that are just beautifying, like cleaning the streets or helping little old ladies that need some work done. And if you don't have somebody doing it, that's just not going to get done. Then that's definitely doing a service that it improves your lifestyle. And those people will then go out and spend the money, which will get more money into the economy, and that will get other businesses going, you know, more productivity, and allow businesses to pay off their loans and, you know, take out new loans. And it just keeps it oils the machinery, like you say.
This reminds me of a couple parks that my family and I went to. One was Hungry Mother State Park in Virginia. And this was a park that was built during the Great Depression years by people that had no jobs at all. So they joined this like CCC, Civil Conservation Corps or something. They built this amazing park up in like kind of up in the mountains as a state park. But then people, when they went there, they would pay to use the lake that had been built, and they would pay to, you know, camp. And so the money was issued to the people who were working there, but then it came back into the state as income later on. So that's both the money creation side and the money extinguishing side. And so something like that could also work, like the public works, where there's a possibility of having an income stream generated from the public work that's done.
Yeah, but even if it doesn't generate anything, as Kane said, I guess, that you could dig holes and fill it back up and pay people for that, and you would still stimulate the economy in a depression, in a deflationary depression where you didn't have enough money, where the money supply had shrunk, because you would get money out there. But of course,
because it's a crisis of there not being enough money at that point. I mean, if there's a deflation, in other words, if everything's price is dropping other than food, so food's going to stay, it might even go up during a deflation, but everything else is going down. That's because nobody's spending on it. So you have to get money out there into the economy. And if there's a restaurant where a restaurant isn't a great example because of the social distancing right now, but say a hair salon or something, and people aren't going to the hair salon because they don't have money. Well, if you get money out into the economy, then they'll go to the hair salon, and then the stylists, they will have money, and then they'll be able to spend their money.
Right. The way they did it during the Depression, the government actually went heavily into debt. And World War II, you know, if you look at these charts of the debt versus the GDP, the debt way outdistanced the GDP. But because there was so much productivity going on, the GDP came up and balanced out the debt over time. So it was actually good for the economy. They always measure, you know, your debt versus your GDP, what percent of the GDP is your debt. And so, yeah, definitely proved the model.
So from my perspective, I think any state could do this in the United States. Any state could buy, they could just say, hey, we have $100 million. We're bidding to buy a bank in the state. And a bunch of hands would raise up. You know, it could be a credit union. A bunch of hands would raise up and say, yes, we will sell ourselves, you know, we'll sell our credit union to you for, and they bid, and then you'd say, okay, you know, we got a good bid. We like this bid. We're going to pay $50 million for such and such credit union. And now we're going to use that credit union and all its technical facilities and everything to do this, to basically make it into a state bank. Is that, or is there a little more complication to that?
No, that's what they could do, but you don't want to buy a credit union. And here's the reason. There are rules that say that credit unions can't lend more than 12.5% of their assets. So you've got all these deposits and you can't really use them as a credit union. I mean, they're just supposed to be taking in money and doing checks and, you know, transferring money, and they can make small loans, but it really wouldn't work for a government bank. What you need is a real bank that's got, I mean, you could set up a brand new bank, but it's going to take longer because you've got to get a Fed master account and, you know, deal with insurance and all that kind of stuff. Whereas if you buy a bank, it's a done deal. Yeah, you still have to do a new charter because you're going to have a different purpose and you're going to have a different board and all that stuff. But it's just a lot easier if you got some of this stuff set up. And the way the Bank of North Dakota does it, you don't really need even a building. You're just running it out of an office. You could run it out of an office in the government. You know, you've already got extra offices sitting around, I imagine, just run it out. The treasurer could run it out of the treasurer's office. Because it's really just an accounting thing. You're just taking money in and lending it out. And you don't have tellers. Well, North Dakota, Bank of North Dakota has these 2 branches, and they do those, you know, very basic low-level things for people that would come in. They're 2%.
It seems like in Michigan it would be easier to, because there's different ways banks are chartered, right? They can be chartered by the state, or they could be chartered by the federal government, and the same for the credit unions. Is that right? So there's like four different forms.
Yeah.
So, and if they could buy either one. Technically, they could buy a nationally chartered or a state chartered. Is that right?
Yeah. Yeah, but for a state bank, you want a state charter because you want to be under your own regulator. And if you're the government, you're the governor, you may want to influence the regulator in some way and say, let's fast track this thing and, you know, go easy on the regulations. Don't worry. Yeah, we the government are backing the thing. So.
Well, the state must have a list of all the state chartered banks, and they could go through and look and say, this is the one that's in trouble, or this is the one that has the fewest assets, and we're going to just go and make them an offer tomorrow.
Yeah, and now that the Fed has eliminated the reserve requirement, and so it didn't really matter if you spend down your deposits, you can just borrow to fill the hole. And they got real flexible on the capital requirement. They said, well, if you need to spend your capital, you know, or lend your capital, you know, dip into your capital, don't worry about that. That it was there for a rainy day, and this is the rainy day. That's what they basically said. So you put up some money in the beginning, but you could probably make more loans than, like if you put up 100 million, you could theoretically make $1 billion worth of loans. But I bet you could get away with making more than that with these new, very flexible rules, which they've done to protect the big banks. But that's the thing, we want to step in and take advantage of all these perks that big banks have that not only do states not have, but they're discriminating against the states. They're penalizing the states for a lockdown that's, you know, for a virus that is not the state's fault.
And they could still monetize assets to the state as well, couldn't they? Couldn't they say, we have such and such a freeway, it's in great shape, it's worth $7 billion. We're going to write that down as an asset on this side. We're going to write down our credit on the other side, and then we're going to give that money.
Well, the problem is that your capital really is there in case the bank goes bankrupt. You know, if you can't balance your books, and in other words, you have a bunch of defaults, then you dip into your capital. That's what the capital is for. Your capital is your real money that you own, but you really don't want to sell off your freeways probably, or your Capitol building, or your parks, or any of those things.
Well, no, I'm not suggesting that. I'm just suggesting that it, just like a house, if you have a house that's worth $200,000 and that's agreed, then there isn't, you can monetize the value of that house, and then you can use that cash within the community, and a state wouldn't have to say it has to be paid off by date certain. You'd never have to pay down the principal, essentially. Although you'd want to depreciate it, you'd want to pay it down at least at the speed of depreciation of the asset. So if the road is getting less and less valuable, then you'd want to say, well, yeah, but it's not as valuable now as it used to be, and so.
Yeah, but I think that
if you have a state forest, though, the state forest, I mean, if it's growing forest, that asset is increasing in value.
Right. Yeah. Well, and I actually did a conference in South Korea last fall. And so I did a lot of research on the South Korean system, and they had a strong public banking system, not so much anymore, but they did for a while until we had the Asian crisis. That's a long story. But anyway, this one economist who wrote a lot on it that I liked a lot, said that you have to stick to the banking rules for international trade as long as you're a member of the World Trade Organization or whatever. But within your own government, you could be flexible on the rules. So you might not, you could say, we don't have to balance our books. You know, we're going to let some defaults happen in our community, and we're not afraid of that. We think it would actually be good for us. So you could have state-owned banks and say, well, yeah, all right, so they made some bad loans, but we're not too worried about that because it's good for the economy. That's what the Chinese do. They call them non-performing loans, and they just carry them on the books. And everybody around the world say, oh, the Chinese banks are going to collapse because they have all these non-performing loans. They're not going to collapse unless the regulators collapse them, and the regulators are part of the Chinese government. So they're not going to collapse their own banks. So, and they're not going to collapse these businesses either, because they think they're better off even with failing businesses than bankrupt businesses. You know, if they're producing something, maybe they couldn't quite meet their debts, but I mean, they're now just in the last year or so, they've gotten more fussy about those things because the whole world is watching them and kind of demanding them that they get with the program. That, I mean, I don't know what kind of pressure we're putting on them, but they have lately put a few small banks into bankruptcy, which has frightened everybody and said, see, the Chinese banks are going bankrupt. But I think maybe arguably it's also because the local banks have kind of broken away from the national banks, and the national government wants to restore control. So they're saying, well, we're not going to let these local, sort of the equivalent of counties, you know, just be creating all this credit and inflating the system and building all these apartment buildings that don't have any people in them, that type of thing.
And in this case, if everybody who wanted a job was paid to build community gardens and plant trees and all these sort of productive things, build parks and clean up places and help seniors and wherever help is needed. Like one of the ideas that I came up with a couple months ago when I thought the hospitals in the area were going to be overwhelmed by these patients was, you know, I'm happy to go, and in fact, anybody who's getting these unemployment checks, not me, I'm not, but they'd probably be happy to go and stand in front of the door and make sure people have got their mask on and wash their hands and stuff. There's actually somebody that's being employed to do that, but they could be brought inside the building to do something a bit more specialized. And then those people could be brought closer and closer, you know, because the nurses were so overwhelmed and everything. They needed help from the techs and the assistants, but the techs and the assistants already were doing other stuff. And so what you can do is you could bring, but there's all sorts of this work that is available. I mean, there's work I'd love to have done, but any municipality, any government, roads, cleaning up along the side of the road, getting, you know, filling potholes with a shovel. And I mean, there's an infinite amount of work that could be done. There's no limit to the amount of work that could be done.
Yeah. And my argument is you can put out money out there where you're not getting work, like for Medicare for All or universal basic income. And we need that because we need to fill that gap between debt and the money available to repay it because of interest, for one thing. But it's not just the interest. To really balance the system, all the money that goes out would have to come back to pay off the loans, but it doesn't. A lot of it goes to rich people who don't spend it back into the economy. It goes off somewhere else into this other system where it just goes round and around in that system, driving stock prices up or just sitting on.
Are you talking about the fire sector, finance, insurance, real estate?
Yeah. Or there's a lot of money that's just sitting there doing nothing. I mean, I have money that's sitting there doing nothing. Like I was starting, you know, a brokerage account, and I have a lot of money that's just, I'm afraid to invest it because I'm afraid I'll lose it. So
what if everyone within a state was invited to move their accounts from their current bank to the state-owned bank? So then the state-owned bank would have a lot more assets. Like I'd be happy to do that. I'd be like, sure, credit union, there you go. The money goes from here to there. The teachers, actually all the public employees, it could be a requirement. We're going to create accounts for each of you this coming fall, the teachers, the school employees. That's where your money's going to go, and you spend it from there. We're going to send you checking accounts and debit cards and everything for all the public employees. For the pensioners, same thing. Your money is not going to go into wherever it was going before. Now it's going to go into your account with the state-owned bank, and you can spend it straight out of there. We'll give you the checking account. And so now all the money's brought under the safety of the public state system, and it's that it magnifies the ability of the state through the state-owned bank to make sure everybody's employed.
Yeah, that's what they did in Japan, where they had the Japan Post Bank was, it's, of course, it's federal, but it's the largest depository bank in the world, and it's publicly owned through the postal banking system. And the Japanese are big savers, so they would, you know, just park their money there at Japan Post Bank. And what Japan Post Bank did with the money was buy government bonds. So that was it was called the second budget or whatever. It was the second way that the government got money, because they owned this bank. And so they got the proceeds to use. So when they say that the Japanese must be broke because they're so heavily in debt, the thing is they're in debt to their own people, and their own people, but their own post office, you know, their own government owned entities.
What do you, before we wrap up, this is kind of an aside, but not exactly an aside. The idea of the U.S. Postal Service, I saw this floated just once in the last month, becoming banks.
Yeah, there are actually two bills on. There's the Kirsten Gillibrand's bill, and one with AOC and Bernie Sanders for postal banks. We had a postal bank, a very strong postal banking system from 1911 to 1967. And it was particularly in the Depression, everybody rushed to the postal banks. They pulled their money out of the failing private banks and put it in the postal banks. But this alarmed, obviously, the big banks or the banking system in general, because they were losing their deposits and therefore they couldn't make loans. And so the government agreed to insure the private banks with FDIC insurance, which, you know, so we propped up the private banks, but let them keep the profits. So we're taking the losses, they get to keep the profits. They should have strengthened the public banking system, but they didn't. And in 1967, under a Republican conservative government, I think that was, anyway, under a conservative, was that Eisenhower?
No, Nixon
This is the
era.
50s. I forgot. Anyway, in 1967, the postal banking system was shut down and under pressure from the big banks.
Well, Johnson.
Okay. Yeah.
So
Oh no, so he was in a Republican.
so this makes me think of you know, the United States Treasury has these, you can buy treasury bonds and bills or whatever, and they have these accounts called Treasury Direct accounts. And so suppose you want to buy some bonds, even short-term treasuries, whatever, you transfer some money by ACH transfer into your federal account, which you have to set up. Of course, it takes a few steps because you have to do it yourself. You can't go to the post office and say, hey, set me up one of these Treasury Direct accounts. But then you buy the bond or whatever, and you know, it matures in 30 days or 90 days, and the money goes right back into the account. And then it's there for as long as you want. You don't have to buy anything at all. So it's the system is actually already more or less there. All they would have to do is match up the post offices with the Treasury Direct system, and you'd have basically a public banking system, a federal public banking system.
Yeah, there's also Bob Hockett, who is a professor who is one of our advisors on the Public Banking Institute. Is he's got such a proposal that he's written up at length. Or I think it's a bill, maybe in New York, I've forgotten exactly. But anyway, yep, good idea.
All right, so let me kind of summarize before we talk about what next to do. So the summary is, money creation is not all that difficult. What you're talking about is two people or a person and an organization or a person in a bank making an agreement about the value of an asset and creating credit and debt at the same time. The debt can have an interest payment or not. It's really up to what kind of organization it is. The idea of an apple, you know, if you have the apple and you sell it to your neighbor and you know that you have a credit of $1 and they have a debit of $1. I mean, it's just a matter of writing it down and making sure everybody agrees, right? Because then you go to them later on and you say, hey, I'd like to spend my $1 to buy your asparagus. And there you go. And obviously you wouldn't do this with next door neighbors because you're sharing stuff anyway. But money creation isn't rocket science here. I mean, people have been doing it since time memorial. And it started actually as like keeping, if you listen to Michael Hudson, I don't know if, are you familiar with him?
Yeah, he's also on our advisory board.
I mean, if you talk to Michael Hudson, listen to his talks, he says, you know, basically the idea was back in Mesopotamia era, people would, you know, be growing the crops, but they wouldn't have money initially. And so what they do is they just go buy beer or whatever. It would be written down that they, you know, they had a beer, so they owe 1 shekel or whatever it was. But when their crop came in and they sold the crop to the granary, then they'd get the money and they'd be able to pay off the accounts. So
Right.
it's really an accounting. It's just accounting. It's just keeping track of actual goods or services being exchanged, who gets the credit, who gets the debit. It doesn't have to be private. It can be public. It can be done by groups. It can be done by a state. I mean, it's not this, you have to have a printing press to make US dollar bills.
Right. Right. We don't really have a money system. We have a credit system. And a credit system is just a matter of keeping track of the credits, like you said, debits and credits.
Okay, so now what? So myself and the 2 people that are still live, and I'm sure there'll be others to watch this, but what now should we do? Because this information is information that it seems like if a lot of people knew this, they'd be like, yeah, we need to do this. And governors, we need to do this. And mayors, we need to do this. And so you've mentioned a couple times the Public Banking Institute. Can you tell us about that and how we can help?
Public Banking Institute was founded in 2011. We went round and round, and we had a Google group and public banking Google group, and we went round and round these issues for a couple of years and decided that we were the experts and it was time to get out there and do something. So we set up the Public Banking Institute, and very quickly we had over 20 bills, and we thought this was quite easy. You know, we were on a roll. We were going to get these banks set up all over the country, but they tended to die in committee or whatever. So now we're on our second round of bills, and there are now 25 active bills last time I counted across the country for of one thing or another, maybe for actual public bank, maybe for a feasibility study for a public bank, maybe to establish a state charter or provisions, you know, for how to set up a public bank. We did pass one of those last year in California. Washington State, well, anyway, we're making a lot of progress, and people are getting more and more familiarized with the idea that we, the people, should own the banks, and that would solve a lot of problems. So that's partly what we do. Like right now we have a
because money should be looked at as a public utility that
yes.
A community, any community, suppose you're on an island, you're just trying to facilitate trade amongst everybody who doesn't know each other already, and to try to keep it fair, right? Because you don't want certain people to get everything. So it's really just a public utility, just like electricity or just like the postal service, communications. And most people don't think of it that way.
Yeah, well, most people think that either they think that the bank is lending its own real money, and then they think, well, okay, they're entitled to interest because they've given up the use of their money for a period of time, which is what is true if you with bonds or something like that, where you actually do take people's existing money. But a bank doesn't do that. And like credit cards, they don't even get the money anywhere. I mean, it's all happens so fast that they're really just writing numbers, and a credit card business is hugely profitable. They're now at 21%. They didn't have to write down their credit cards just because they got to borrow for free at the Fed discount window. anyway, you could set out that up as a public system much more cheaply.
So how do we get this sort of information out there? Because this is, I mean, this was like an hour and a half, and I think there's enough clarity in this, and it could be, of course, improved on how simple these ideas are. How do we get these sort of ideas into the masses? Because getting them to a secretary of treasurer for a certain state, or getting them to the governor, and the governors are overwhelmed right now, right? So how do we get them into the people's mind so the people are like, hey, this is what we need to do? And, you know, because we don't have jobs and we're not getting our checks, and we're going into what looks like to be a depression. And we can see deflation because all the prices except for food are going down. Well, maybe gasoline might not, food and fuel. I mean, those are like the two things that might not go down. And even fuels went down. So how do we get this word out? Are there resources like maybe YouTube videos or like little memes to put on Facebook or?
Yeah, well, our website is publicbankinginstitute.org, and we have all sorts of resources there. We're now doing a series of town halls, so online, you know, so if you wanted to do an online town hall, like one man approached me from Uzbekistan. He wants to do one in Uzbekistan. I mean, he's here in Virginia, but he wants to do a presentation for politicians in Uzbekistan because he thinks it would, you know, they're ripe for a public banking system that would work really well there. And actually, my ex-husband used to be head of USAID in Kyrgyzstan, and he said, yes, it would be perfect for them. So we've got this PowerPoint that you can use to help you make a presentation to your local officials or your neighbors or whoever you'd like to present it to.
Is there a video of an expert delivering that online as like a model?
Well, it's a PowerPoint. And so if you did it, for example, you would do the PowerPoint.
Well, sure, but what I'm saying is,
but one of us
knowing what to say is challenging. Is there, like on the Public Institute website or on YouTube somewhere, is there somebody giving this PowerPoint so we could listen and be like, yeah, I could do that same. Okay, I got to remember that point. Yeah, this slide is not, I got to say this thing. You know, because
I tried to, I just finished this set of PowerPoints, and I tried to make it, you know, full sentences so you could see what's happening here. And then one of us comes on at the end, you know, we're available for questions and answers. And so, you know, so the audience can ask. So it's interactive. It's a Zoom. I mean, you do it by Zoom. And so people, that's the difference between us just putting something up there on YouTube and people get to watch it. But then if they have questions, there's, you see what I mean? It's an interactive, live PowerPoint, hopefully given by a local person. If forced into it, I suppose I could do it, but I don't have that much time.
Well, I think you should do one and then put it on YouTube.
Well,
let the rest of us, you know, take it from there.
Yeah, we have two up there right now, one in Colorado and one in New York. But the one in Colorado, I did a PowerPoint, and then another man who's the head of the Colorado. We've got public banking groups all across the country. So if you look at or contact us, it's I think communications@publicbankinginstitute.org or giving. Anyway, it's the emails are on the website. Contact us, and if you want to find a group that you know in your locality that knows the status of things. And if you don't have a group, we'll help you set one up, etc. So that's what we do. We're just there to help get information out, and any way we can do it, we're happy to do it.
I want to point out Keith online at the very beginning, he wanted to make sure that we hit the point that the global economic system as it is at the moment uses a huge amount of energy. I mean, millions of barrels of oil and tons of coal and all this energy. And this is something that is going to, can't go on indefinitely the way it is. It's not going to be replaced by solar and wind and whatnot. But that doesn't mean that this won't work. I mean, when you're talking about going out and building gardens, that doesn't necessarily have to be a high energy intensity thing. So you can put the money towards things that do not require a lot of energy importing into the country. And that's critical because, energy isn't infinite, like oil. It's not. And it gets, and you can see with the fracking wells in North Dakota, for example, number one, they were not, you used more energy to get the fracked oil out anyway, but even then, it's important to realize that money rests upon reality. And so just like you've been saying, Ellen, there has to be something created upon which, or you have to be basing it on some future production, or right. So I mean, you can't.
But there are many things you could create that don't, well, say education or research. We need a lot more research. We need research that's not funded by drug companies and, interested parties that are going to corrupt it and use it for their own purposes. We need pure research done by the government. For example, you could do research on how to clean up the oceans. I mean, I'm sure people are working on that anyway, but there are lots of things you could do that would be make resource use more efficient than it is right now. I mean, ideally, I think we're going to come up with free energy, don't you think? I mean, many people.
No.
So.
Well, I mean, sunlight's free. So in that sense, yeah. I mean,
that type of thing. Yeah. Plants do it. Yeah. So, and then nothing would be better for the whole planet than planting trees everywhere, that type of thing.
Oh yeah, we could do that. We could do that for decades. That would be awesome. Well, not just trees. I mean, I would be planting fruit trees, Johnny Appleseed all over the place, but not just the same apples. I mean, just think of the abundance of food there could be.
Yeah, apparently that's what they did in, no, blank. Anyway, yeah, agreed. Fruit trees, that's what we should have. I live in this senior village. We have this vacant lot, and we were discussing what to do with the vacant lot. And I said, well, why don't we plant fruit trees? And the older women where I live said, oh no, because then people would steal the fruit. Well, that's the point.
You could have someone sitting out there selling the fruit for like almost free, and you could have someone, yeah, sure, but you got to pick up the branches first,
Yeah, or just it seems to me in a community where you all know each other and you help each other, you're not going to steal all of it. You're just going to pick a piece here and there, right? And the alternative is to have a vacant lot or to have trees that don't have fruit. Well, why not put in some trees with fruit? Anyway, we kind of have to change our mindset. It seems to me we're so focused on, we're so suspicious of people as a culture. I think maybe just because we are so many different cultures. It's not like in a country where, I remember it was Yugoslavia before the Iron Curtain came down. While Yugoslavia was still a socialist country, they were the ideal model of sort of a socialist capitalist combination. And somebody said that it really was like paradise, that people just planted fruit trees because they felt like it. And you could go along and pick fruit if you wanted to. Nobody worried because there were a lot of fruit trees and people didn't steal it. It's kind of like you would picture a old Indian community or whatever, where everybody knows that it belongs to everybody. You take what you need, but you don't need to hoard it because the trees will be bearing next year as well.
This reminds me of the story of Cuba after the collapse of the Russian economy in the late 80s, 87, I think, and they stopped sending oil to Cuba and no one else would sell Cuba oil. And so Cuba had to convert quickly from a high fuel industrial ag system to a organic gardening, everybody organic gardening wherever they could. And there's a couple films based on that. One is called The Greening of Cuba, and others called How Cuba Survived Peak Oil, basically, which energy, energy being cut off. And so this can be done. And what they did, if I remember correctly, in Cuba, is they got the gardeners, and the country said, hey, gardeners, we're going to pay you to teach everybody how to garden. And so that was another way where, you got everybody, because people don't actually need money, right? They just need food. So
Yeah.
if you're getting everybody growing food, I mean, obviously there's some things that other people, there are a few other needs, right? So you need medicine. Some people need medicine. You need shelter, but most people have it. You might need some repairs. You need electricity, but that's really a public utility. So anyway, this is going too far, but
Possibilities are endless. Yeah.
yes. Okay. Well, thank you so much, Ellen, for being on the call. I really appreciate it.
Thank you, Aaron. It was great to talk to you again.
And if you are watching again, please, if you could hit the thumbs up, that'll help people see this. And if you could subscribe, that's awesome. And hit the bell so you get notifications, set it to all notifications. Also, if you can share it with someone on social media or via email. And maybe there's more succinct videos online, so look around. Why don't you look for public banking or state-owned banks or things. Also,
I should say my website is ellenbrown.com, and I've got hundreds of articles there, so lots of research if you're interested.
And is your book still in print except on the 5th edition?
5th edition, yes. So a couple, I think the 2010s still in print, on Amazon and on, Barnes and Noble, that type of thing. And then I have 2 other later books, one called The Public Bank Solution and one called Banking on the People, Democratizing Money in the Digital Age.
That's very interesting. Hey,
it's written last year.
By any chance, do you know, like any of the local currency folks like Tom Greco? And,
oh yeah, he's
okay.
actually on our advisory board too.
Okay, I had him on a call about a month ago. So, all right. Well, thanks again, Ellen, and thanks for those of you that were on the line with us today live, and also everybody in the future who watches this. Thank you so much. There are solutions. We just have to look back in history and look to other places and be creative. There are many solutions, and we can do it together.
Thanks, Aaron.
Thanks, Ellen.